Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, my guest is Dohn Thornton. Dohn is a specialist in estate planning and using trusts, both irrevocable and revocable trusts, to protect assets and minimize taxation over your lifetime. He joins us today to share a specific strategy he uses to help his clients, mostly business owners and real estate investors, minimize taxation on their assets. Just a little bit of forewarning, today's episode is somewhat technical. That's often the case with these kinds of estate planning strategies. But the result, if you use them properly, can have a profound impact on your finances, which is why I wanted to have Dohn on in the first place. So Dohn and I did my best to sort through this issue, Dohn being the expert with this specific strategy, me trying to slow him down into a more digestible format. But the result was a really interesting conversation and potentially a strategy you could use if you have substantial income and assets that you'd like to protect over time. You don't mind not owning a whole bunch of assets as you, the individual. You're comfortable selling those assets to your own trust, and a variety of other factors Dohn shares with us in detail today. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Dohn, welcome to the podcast. Thank you for spending a little bit of time here with us today.
I'm thrilled to be here. Thank you very much for the invitation.
You have a very interesting perspective and strategy that you help business owners with, and I'm very curious to dive into the specifics of that and how it all works. But my first question for you is about your name. Your name, Dohn, D-O-H-N, is kind of an unusual spelling. Where does that come from?
My grandfather did not want anyone to call my dad Donald. So he stuck the H in, and I inherited it because I'm Dohn Thornton II.
Yeah. Very logical, pragmatic. I like it. It's one of those names. So my name is Grant, right? And our listeners probably know that. And I love my name. It's unique. There are not very many Grants out there. The one area where it's a little bit of a challenge is if I'm in like a loud setting, like a bar or at a concert or something like that, and I'm introducing myself. G off the back of your tongue is hard to enunciate and project. And Don, John, Chris, those kinds of names are a little bit easier to project. I don't imagine you've had much of an issue with that.
No, but I have had an issue of being called John and Dohn and Dohn. So
Dohn is a good one, depending on how your day's going, right?
Exactly.
So tell us about your work life. What are you up to today, and what does that consist of?
I have been a real estate investor for 21 years, and I have, I've survived 2 booms and 1 huge bust. But I'm a short sale investor, so we thrive in the bear type market. But I tell you what I'm doing now. For the last couple of years, I've been focused on educating people on how to legally reduce their taxes by a huge amount. And I have this trust that does that. And I decided that, short sales are a little slow. Why not, turn lemons into lemonade and educate people and get them having the same benefits that I've been having in my real estate investing business. And it's been great.
So for our listeners' benefit, oftentimes, particularly in our financial planning firm, we work with business owners on estate planning all the time. And usually that consists of making sure that whomever you want to inherit your stuff after you're dead gets them in the most expedient and efficient way possible. It's setting up mechanisms to make sure that whomever needs to get into your accounts and make decisions if you're incapacitated while you're alive is able to do that. And oftentimes, because most states do not have a state estate tax, Oregon and Washington are a few that do. There's a federal estate tax, but it doesn't kick in currently until you have about $12.5 million to your name. So for most of the people that we're working with, that's not an issue, right? And that's usually the land where irrevocable trust planning comes into play, because you have life insurance that you might want to park into in a trust to provide liquidity after your death to pay the taxes. There are a lot of other ways that you can use these kinds of trusts to mitigate estate taxes after you die. And you're using them for a slightly different purpose. So run us through this piece by piece, because this piqued my interest.
Well, the official name of the trust is a non-grantor, irrevocable, complex, discretionary spendthrift trust. Okay, that's a mouthful.
And we can't just come up with some new term here. Well, I guess it has to have all those in there, right?
We talk about it as a spendthrift trust, but it's more than just that. And the spendthrift trust is just the asset protection side of it. The four pillars that have to do with tax reduction is the non-grantor, irrevocable, complex, and discretionary part of it. But this trust has been around for a long time. It was originally developed, the first version was developed back in, about 70 years ago. And it was a attorney, obviously, that worked under one of the most famous trust experts in the country at Harvard. And he went off on his own, and he basically started a career on Wall Street in a prestigious firm, building trusts for rich people who didn't want to pay taxes, And so then, he started modifying it, and the version we have now is about 50 years old. And it was mostly in Texas, in the oil, gas, and mineral rights area for decades. Now, it was copyrighted in the end of 1999 and end of last century. And it's been slowly building and building and building by word of mouth, because of the attorneys weren't promoting it, and so it just grew. And now that they contracted with us to start promoting it, it's starting to get more and more widespread attention. And I was fortunate to hear about it because I heard from a friend of a friend of a friend who knew about it. That's how I learned, because it was you're just not going to call up most estate planning attorneys or tax attorneys or CPAs and say, hey, do you know how I can basically, have any passive income that comes into my trust to be non-taxable or not pay any capital gains tax legally? They would say you can't do it, But with this trust, you can. And that's why it's a very niche trust. And most trusts, they're statutory law trusts. They're governed by, the tax code that's not governed. This code is different. This trust is 100% IRS code 643B compliant trust. And that is a very specific kind of trust. Okay. The biggest things about this is that, according to the code, that the governing instrument of the trust cannot require any beneficiaries receive distributions. Okay. You can make a distribution, but you can't be required to do so. And number two, that all of the money has to be allocated to the corpus of the trust. And so what this is that with IRS code 643B, when you have any kind of passive income, that could be investment income, it could be limited partner profit sharing income, it could be rentals, it could be lease payments, anything like that comes into the trust, that's not going to be a taxable event for the trust. And, the whole idea is that you keep everything in the trust. You don't want to disperse anything. You don't want to do any distributions. So the trustee is a non-grantor trust. So the trustee has 100% control of the trust and can make all the decisions about, how to, help out the beneficiaries, how to support them, how to pay trust expenses, and so on and so forth. So case in point, I'm the trustee of my trust. My wife is a beneficiary. My two adult children are beneficiaries, and my grandson are beneficiaries. My wife is successor trustee. So if something happens to me, she takes over. Okay. We sold all of our personal and business assets to the trust. So my real estate investing company, I sold everything to the trust, all of our real estate, rentals, everything we have, our cars, we sold them to the trust. Now, we sold it at a cost basis value because we don't want to trigger capital gains tax events, an irrevocable trust, so it has to be sold in there. Now, the trust, because every sale you have to have some kind of consideration. In this trust, the consideration is a note, and we call it a demand note, which is basically like an IOU, where you can draw upon that whenever you want, and that will not be a taxable event. Now, the trust can pay for every single expense that has to do with the assets of the trust. So, for example, when the car, the utilities, getting a lawn mowed, anything that is done for all of those assets, then the trust pays for those as trust assets, and it's paid for by essentially non-taxable money that's coming in that's not going to be taxed. So, and then it also obviously pays for pretty much a majority of the expenses for the beneficiaries, except for what we call the 3 Fs: food, fashion, and fun. That can't be paid for out of the trust. But the dominant thing about this is what makes it so unique, is that when this passive income comes in the trust, or any capital gains income comes in the trust, from selling a capital asset, then we're not offsetting expenses with income and vice versa, right? What we're doing is we're just basically reporting this to the IRS on the 1041 that we file with them. But the difference is that we tell the IRS in the tax return, we are taking a IRS code 643B election. And by doing so, we're declaring that all of this income that has come in passively into the trust is a extraordinary dividend for the trust. And of course, it says basically in the code that by doing so, this income is not considered income for the trust. And if it's not considered income, it's not taxable. So that's how it works. And, there's been at least between 80 to 100,000 trusts have been sold in the country since the last 50 years. If you think about that, if you multiply, say, on average, per trust, at least 10 tax returns have been filed in that period of time, then, you're talking about hundreds and hundreds of thousands of tax returns have gone through. And, there's never been an issue with the IRS because it's legal and never been an audit. And, I've had experience too with myself as far as with this, and it's been a game changer. And the I don't want to say it's sad, but it's gonna change. It's just the fact that not many attorneys and not many CPAs even know about this tax code and know how this works, because it's a different set of rules than they normally have. Like, for example, there's no way you could do this with just a plain irrevocable trust or a revocable living trust. You just couldn't, it wouldn't work. But you can with this one. And that's the thing. So it's just about educating. It's just about getting the word out and educating people. There is another way to do this that's better, in my opinion.
Gotcha. Okay. So I think I've followed everything that you said, and I'm taking a few notes here as we go along. I'm guessing that our listeners have probably not, because there's a whole ton of technical stuff that you just explained to us. So let's go through this piece by piece.
Okay.
My first question is less has to do with the structure and technicalities of these, and more so about the history. So the format's been around for 70 or 50, 70 years, something like that.
Yeah.
Some law student at Harvard had a nice career on Wall Street structuring this for people. And then a law firm in Texas copyrighted the trust.
He moved to Texas.
He moved to Texas. Excuse me. He moved to Texas. Same person. Yeah. But then he copyrighted the trust. And that is interesting to me, because it seems like this structure should be available to any citizen, regardless of whether one individual can copyright it or not. Am I understanding that right? Could somebody use this structure without violating the existing copyright?
Well, no, and that's the reason. The reason why the existing chief legal counsel of the trust is, his history is with personal injuries because Robert Benson, he was the original partner. He brought him on, Paul Rosen from Houston. He brought him on specifically to litigate against copyright infringement because there's a lot of people that started hearing about it. So they started doing copycat trusts, and after they copyrighted it, and so they jealously defend their copyright. And so, it's his intellectual property. He put it together. And so, he has every right to copyright it, which he did. And now the law firm defends it very zealously to make sure that nobody infringes on their copyright. That's their intellectual property, right?
Sure. And I am a huge proponent of intellectual property and copyright laws. It seems, am I misunderstanding this? It seems to me that let's take a really simple example, an irrevocable life insurance trust. If you're running into a big estate tax issue, if you think you're going to owe a lot of estate taxes after you die, your estate doesn't have the cash to come up with that. Oftentimes, you create an irrevocable trust, put a life insurance policy in there. When you die, the policy matures. You get a death benefit to pay off the estate taxation, right? That's a strategy, a mechanism that's available to everyone. There's no one person that owns the copyright on that strategy because it's just every individual's usage of the tax code. How is this different than that? Why couldn't somebody use the same sections of the code in a similar way?
I mean, they can certainly try, right? I mean, Mr. Benson, he wrote this, modified a number of times, got it copyrighted, and no one's saying that you can't go out and, set up a non-grantor irrevocable complex discretionary spendthrift trust. But, if it's even close to what they're doing, then they can dispute it and say, look, that's you're infringing on our copyright. So
right, and to be clear, I'm not suggesting that somebody run out and copy the language of an existing trust, right? I'm just saying the law is the law. Nobody can own one, area of the law.
Again, you're talking about the tax code. That's the apples, right? That's what exists in the tax code that allows this type of trust to work. To what we're wanting, the tax reduction, and obviously the spendthrift trust, the asset protection is a whole different thing. But, it's a question of, can you construct a trust that is 100% compliant with 643B to allow you to do this stuff without going to jail, right? It has to be in compliance. And which this one is, because, when it got copyrighted, the IRS vetted it, went through and said, yeah, you're good. This is all legal. And so, I think it's almost like, when you invent something, you've got a certain period of time before anyone can come in and just, there's no protection anymore, like a patent or whatever. So this is, I don't know the whys on this. I'm just.
Sure. Yeah. And I don't mean to harp on or press on it either. It's just, this is genuine curiosity. Is the first thing that came to mind when you started describing. I think my question is answered, and I appreciate the background. So for the benefit of our listeners here, just real basic estate planning. Again, you have two types of trusts, or let me put it this way: trust can be categorized in a number of different ways. One way is the difference between revocable and irrevocable trusts. What you're doing is you walk into an attorney's office, they draft this trust document, it creates this separate legal entity. In a revocable trust, which is far more common, and a lot of our clients use these for their own estate planning because it bypasses probate and all this. You form the trust, you put your assets into the trust, you can name beneficiaries as you want, you can you have control over the distributions. If you have minor kids, you might want them to not receive everything that you own at age 18. You might want to spread it out into their 20s and 30s. That's a really common technique. And in a revocable trust, you can take the assets out. All the tax ramifications of what's in the trust passes back to you as the grantor. Grantor meaning the person that put the stuff in the trust, right? The other kind is an irrevocable trust. You create a different legal entity, you put assets in there, you either sell it to the trust, as you mentioned, Don, or you gift them to the trust. It has its own tax ID number. And from that point on, the assets are in the trust. You can't take them back. And so what you're describing is an irrevocable trust that's a non-grantor trust, which means that the trustee, the person responsible for handling the assets inside the trust, is different than the person that put the assets in. Did I get that right?
No.
Okay.
In a non-grantor, then, so in my case, right? So I invested the money in this trust, but I'm not the grantor. I did not create it officially. I got a settlor to do it. Okay. So the settlor creates the trust. So when my EIN, when my trust EIN number was created, it was created with the social security number of the settlor. Okay. That settlor then named me the trustee of the trust, and then he resigned.
Got it. Okay.
So now the trust exists officially before I was named trustee. So therefore, I have control of the trust, but I'm not the grantor.
I understand. Okay, got it. And so, and that makes no difference surrounding when you sell the business and real estate and other assets into the trust in exchange for an IOU. Is that right?
Yeah,
because the settlor is still with you.
Yeah, the settlor is gone at that point. Because now that the trust exists as its own entity, its own EIN number, I'm now the trustee with 100% discretion to do whatever needs to be done for the trust. At that point in time, me and my wife, we can start selling our assets into the trust, which is what we did. Okay.
Right. Okay. And when you say so, at this point, trust has been established. You've been named as trustee. The settlor has resigned. And now you're selling assets to the trust. Yes. And when a lot of people hear that, I'm suspecting they're saying, well, why does the trust have any money to pay you for your business? Are they taking out a bank loan? They're not. There's nothing inside the trust. You're selling your assets to the trust, assets going to the trust in exchange for an IOU, right? So a commitment from the right, a commitment. Okay, command note. And what does that command note give you as the individual the right to do?
Okay, so obviously in any kind of a sale, there has to be consideration, right? So the consideration in this transaction is a demand note. Now,
consideration meaning something in return for what you're putting in the trust. Yeah,
exactly. Yes. So what happens now is, as trustee, I pay for everything that has to do with the expenses for the assets of the trust. Mortgage, all that stuff. Every single thing it has to be paid for those assets. The trust pays for that. I handle that as a trustee, and because I control the bank account. So, and then again, there's minor children, for example. The trust can pay for pretty much anything that they need: education, medicine, whatever. They can food, all that kind of stuff. It's a little bit more limited on what the trust can pay for adults, but I guess the big three they can't pay for: food, fashion, and fun. But here's how I do it, and I work out with my accountant, is that basically I pay for every single thing that I ever, anything I spend money on is with my trust debit card. Okay. So at the end of the year, we're getting ready for tax time. Then on our bookkeeping, anything that does not qualify as a legitimate trust expense gets moved over to the demand note column. Okay, so we have approximately $2 million in our demand note that the trust owes us. So if over the course of the year, $70,000 that I spent, or the trust spent, was not on a legitimate expense for the trust, then that just reduces my demand note by $70,000.
I see.
You see?
Yep.
So
okay.
That's because that's not taxable. I mean, whatever. And listen, if I wanted to, I could go and I could have the trust cut me a check for $70,000, and you can do that as well. It's just easier to do it this way, just to make that thing. So basically, that's how we do it, and it works really well.
Right. And if you were to work that demand note down to zero, what do you do? That you just cut a check to yourself from the trust instead of going that route, right?
That would be considered a distribution at that point in time. If you can't borrow from the demand note, then that's a distribution. You pay taxes on that.
Okay, got it.
Yeah.
Got it. And so one of the key mechanisms there is being able, I would suspect, being able to sell enough assets to the trust to create a reasonable amount of on the demand note, right? You don't want to do this with, $50,000 worth of business assets. You want to do it with
it
a lot
wouldn't
more
make
than
much
that.
sense to do that. No, but I mean,
Okay.
business owners. I mean, think about this. Okay, so our tax strategies to help business owners be able to legally reduce their taxes by a huge amount. What we'll do is, like, for example, with an LLC or an S corp, it doesn't really matter. But you want to sell your business assets over to the trust. Okay.
Mm-hmm.
So at that point in time, the trust is going to own all of those. And so what we want to do here with the business is we want to reduce the taxable income for the business. So what we're going to do, I'm sure you've heard of this before, we're just going to do a leaseback strategy. So the trust is going to lease that back, and you can go as high as 70% of the previous year's taxable income as a lease payment, as a lease agreement. You can make payments monthly, quarterly, whatever you want to do, whatever your cash flow allows you to do. But if you had, let's say a taxable income of $1 million in your business, well, you can move as much as 70% of that over to the trust as a lease, for a lease agreement. So now you're lowering your taxes of your business down to, let's say, around $300,000, which I'm sure you understand that's going to be a significant decrease in how much you're going to pay in your taxes than you would have in $1 million, right? So then, and that money going from the lease over to the trust, well, a lease agreement, lease payments are considered passive income for the trust. That will not be a taxable event for the trust. Okay, so this you get the best of both worlds here, because number one, now all your business assets are protected in the trust with a spin-through provision that's next to impossible to penetrate unless you're doing fraudulent conveyance or something criminal. Okay. And so then now you've got this set up to where the leaseback strategy allows a significant amount of your taxable income from your business to go over to the trust. It will not be taxable. But now you have, as trustee, you control it, right? To pay for trust expenses. And if you want to make other investments, you do. If you want to buy real estate with it, you buy real estate. You want to buy crypto, you buy crypto. It all becomes trust assets. Okay? And so if you decide that you want to flip a house or you have it for a while as a rental, all that rental income coming in is not going to be a taxable event for the trust because it's passive income. If I decide, I've got this fourplex and I want to sell it, and so now the trust lists it with the realtor, it's sold, the proceeds come back into the trust, and there's no capital gains because the sale of capital assets for this trust are excluded according to IRS Code 643B. So the money just stays inside the trust, and you just use it for other investments wherever you want to do. And so, yes, you mentioned life insurance before. A lot of our clients will get, a whole life policy or IUL or whatever, and the trust will own it. The trust will be the death beneficiary. And, a lot of people use the tax savings they're getting with this strategy to pay for or finance the premiums for a policy, which they can then borrow against and invest and do the whole thing. So,
sure. Okay. So I've followed as far as creating the entity, getting assets in there,
right,
and using the assets using investing and so forth, assets once they're in the trust. Mm-hmm. Can you dive a little deeper into this section of the tax code that I'm unfamiliar with and why these types of income are not taxable to the trust when in any other type of irrevocable trust they would be?
Yeah. I mean, if you give me a second here, I'll just bring it up.
Yeah, let's do it. Now we're talking.
Let's talk taxes. All right. So let me get over here. Give me a second. All right. So I'm reading from the tax code here. Capital gains and losses. Gains from the sale or exchange of capital assets shall be excluded to the extent that such gains are allocated to corpus and are not A, paid, credited, or required to be distributed to any beneficiary during the taxable year, or B, paid, permanently set aside, or to be used for the purposes specified in section 642C. Okay.
And can I stop you right there just to kind of explain what that means to everyone? So corpus means if you put $1 million into a trust, that's the corpus. If it earns 10% a year, you have $100,000 of income in the first year. A lot of trusts will require that income to be distributed to beneficiaries instead of being reinvested in that corpus, the first $1 million. And so what I heard you say is that there cannot be a stipulation where any income that's produced by trust assets has a requirement to go back to the beneficiaries. It has to go back into the corpus to be used continually. Did I explain that adequately?
That is correct, yes. And that's one of the reasons why this is a complex trust.
Got it.
So right there, because a complex trust, you're not required. That's the big thing, is it cannot be required to distribute to beneficiaries. And as a complex trust, it does not. There's no requirement. Sure. Okay. All right. And then about the passive income part of it. Okay. So this is referring on Section 4, extraordinary dividends and taxable stock dividends. For purposes only of Subpart B, IRS Code 643B, relating to trusts which distribute current income only, there shall be excluded those items of gross income constituting extraordinary dividends or taxable stock dividends, which the fiduciary, acting in good faith, does not pay or credit to any beneficiary by reason of his determination that such dividends are allocable to corpus under the terms of governing instrument and applicable local law. Okay, so that's where we introduce the extraordinary dividend part of this. Okay, so and then we have another. It goes to the income part, B about income, where it says for purposes of this subpart and subparts B, C, and D, the term income, when not preceded by the words taxable or distributable net, undistributed net, or gross, means the amount of income of the estate or trust for the taxable year determined under the terms of the governing instrument and applicable local law. Items of gross income constituting extraordinary dividends or taxable stock dividends, which the fiduciary, acting in good faith, determines to be allocable to corpus under the terms of the governing instrument and applicable local law, shall not be considered income.
Okay, I think I digested the first part of that, and then I lost focus. There's a lot of tax law right there.
So when I file my tax return with when my trust files a tax return 641, we 100% transparent. You might as well be having a spotlight, neon light, the IRS saying we are taking a 643B election.
Yep.
Declaring this income that came in passively into the trust as an extraordinary dividend.
Okay.
By doing so, it is not considered income according to the code. Again, has to be allocated to the corpus, cannot be required to distribute to beneficiaries. Okay, and so by doing that, this has been, like I said, it's been 50 years that this trust has been doing this, and there have been any issues because it's legal. It's 100% compliant with the code. Now, it's just like, think about this from the point of view. Now, if I took a distribution for myself, I owe taxes on that. Okay, if I try to run a business with this trust, I will pay taxes on active business income, right? But if it comes in passively and is declared an extraordinary dividend, and of course, again, everything that goes through here is completely given to the IRS. All the expenses going out, the money coming in, it's all there. Mm-hmm. But the difference is that by declaring that passive income to be an extraordinary dividend according to the code, then that is not considered income. If it's not income, it's not taxable.
Got it. Okay. So you can't, any active income, this doesn't work. You're still paying tax. You can't, if you have a business that's kicking off $1 million a year,
right? You
stick that in the trust, the $1 million a year is still going to be taxable to you.
That's why we do it the other way.
Right.
You have a business that's earning active business income, right? Mm-hmm. So the business sells its assets to the trust leases them back. Mm-hmm. Now you're converting that active business income into a lease payment or a lease agreement with the trust, which lease payments are passive income for the trust.
Mm-hmm. Yep.
So
Okay.
that works. Now, if
Yep.
you have an LLC, you can go a step further. If it's an LLC, you can make the trust a 90% limited member of the LLC, and then you can get that down even lower. So, for example, if you had an LLC, same example of $1 million of taxable income. So you take the 70% on the leaseback strategy. Now you're down to 300,000. 90% of that can go over to the trust as a K1 distribution for limited partnership income, which is passive income for the trust. And so you'd move another 90% of that 300,000 over to the trust. So
The
now
K1 is still passive income, even though it's a active member of the LLC?
Limited partnership profit sharing is considered passive income for this trust.
Ah, okay.
Yeah.
Okay. So as far as getting the money out to pay your own expenses, there cannot be a stipulation where there has to be a distribution to the beneficiaries, but you as trustee can take money out for your own expenses. And as long as they're not food, fashion, or fun,
no, that's not how it works.
Then
I don't take money out ever. Okay.
Okay, you don't take money out ever.
The trust pays for things.
The trust pays for things.
Yeah. So you don't. The way the strategy works is that the trust pays a third party. It doesn't give you the money to pay them. That would be a distribution.
Got it.
My son's in university right now. The trust pays his education, his tuition. It doesn't give him a check and say, go pay the university. All right.
Right.
So the trust bought him a car. The trust did not give him a check and say, hey, go buy yourself a car. You see?
Yep.
So the trust does not give him a stipend to go buy food.
Mm-hmm.
Okay. What it does do is it pays for a meal plan at the university. Right. That's how that works. And whatever is not a trust expense, you can draw from your demand note.
Yep.
To be a non-taxable event.
Got it. Okay. Interesting. So at what level of assets does this start to make sense? We don't want to do it with 50 grand.
I don't know. I mean, I would say probably the client that I have that I educated and brought into this trust that probably the least amount of income was he made a little over $100,000 as an owner operator truck driver. And so he had two major pain points. Number one, he was paying about $25,000 in taxes, which he wanted to lower. But also
on 100 grand of income?
Yeah.
Oof.
I don't know. I'm just telling you. So anyway, but his other main pain point was that, his fear was, what happens if I get into a catastrophic accident and they go after me above and beyond what the insurance can cover, and they get everything, get my house, they get my truck, they get my business, I'm screwed, right? So it was a combination of the asset protection. So he sold his truck, he sold everything in his business to the trust. So the trust has that, and it leases it back, so that reduces his taxable income, and so he probably won't pay much at all in taxes from that strategy. And he's got his assets locked up tight, so nobody can get to him or his asset.
And this guy had about $100,000 of income, and what was the total amount of assets he sold to the trust?
Yeah, and he put his house into, he sold his house to the trust, his vehicles, but mainly it was his truck and the business assets, his house, and a couple of vehicles. And that was really the full extent of what his assets were. And so he's thrilled because it works for him. Now, I have million dollar clients as well, So, I mean, right now we're working with about 225 dental professionals around the country that are selling their practices to private equity firms. And what they're doing this exact same strategy because they don't want to pay capital gains tax on the sale of their business, their practices. So the same strategy: sell everything, every single asset the business owns, get it to the trust, as a sale at cost basis, and then they sell the business by doing an asset sale to the private equity firm, and therefore it goes into the trust, and there's no capital gains on that.
Right. And that's a stock sale or an asset sale to the trust?
Asset sale.
Asset sale to the trust. And that's ultimately what the private equity firm is going to want to purchase anyways, the assets.
Yes, exactly.
So what's the price point for getting into the documents, and then obviously you have to have an accountant every year prepare the return for the trust that knows what they're doing. What are you talking about in terms of upfront and annual cost?
It depends. Well, there's annual cost is only what they privately agree with the accountant to do their taxes for them. I mean, I do my bookkeeping myself, so I mean, my accountant charges me $1,000 to do my trust return every year. Okay? So
it's pretty standard for a trust return.
Yeah, exactly.
$1,000 is
right. And the difference is, what I tell people is like, look, if all you want to do is protect your assets, you want to make sure that they go to the people you want them to go to. Does it go through probate? No one can challenge your will. I mean, a irrevocable living trust is perfect. It's fine. I mean, there's no problem with that. But if you want to get the asset protection this can provide and, significantly reduce your taxes, then you can get both with this. But you're getting more value and it's more expensive, right? I mean, it doesn't even compare to what you would normally charge for a simple living, revocable trust. So it's going to be more. So I would say, to answer your question, we never like to quote price at the beginning because we don't know what people want, what they can do. But I tell you that 20 to 25,000 to start, up to 50, 60, depends on what they want. I mean, we have more sophisticated, things. I mean, if for example, I'm right now getting a client, they're in New York, professionals, they make really good money, W-2, and they're getting killed on taxes. He says, look, about 50% of our money is just going between the feds and the state. We're paying like 50%. And he says, what can we do? I says, well, we have an option for you, and we can set them up with a charitable trust. And that's another way where they can invest as much as 60% of their gross adjusted income over to the charitable trust, which is a 501c3, and then they can keep 5% inside the charitable entity, and then 95% of that money that came over can now be invested. They can invest, and then whenever they take profit, then
you can take money out of it too in a remainder trust. Yeah.
Well, in this trust, you can't. Remember, we don't take distributions, but what happens is that once they take their profit, 95% of that can go down to their spendthrift trust, their personal trust, as passive income, because they have a profit sharing agreement between the two trusts. So, and then that's how they can. So if you do, like, say, 600, so you move $300,000 over to, that's going to reduce your taxes by $300,000. That's a deduction, charitable deduction. But if you gave that to the American Cancer Society, you get the deduction, but that would be it. But with this strategy, you can get it over to the charitable trust, and that money can be 95% of it can be invested, and then 95% of the profit can go down to their personal trust as profit sharing between the two trusts. And so that way they get the best of both worlds. They get the deduction, and they can be making income on the money that would have been gone if it was a charitable trust, and they get, it works pretty well. So I mean, that obviously that type of more sophisticated strategy costs more, right? So that's pretty much that. I hope that answers your question.
No, I was just curious what the range was. So in the marketplace, so I live in Sacramento, California, and locally and kind of up and down the West Coast, if you walk into an attorney's office and you need basic estate planning done with that revocable living trust that we've been talking about, maybe some powers of attorney, advanced medical directive, kind of your basic estate planning package, you're looking at like $2,500 to $4,000 in just the marketplace today. And that's the most basic stuff. This is not basic by any means. And it's more valuable, and it's clearly going to cost a little more. I do have a follow-up question after hearing you explain the example of your client in New York. Every state has a different tax structure. There are you're in Florida, is that right? So you don't pay income taxes in Florida, right? In California, we do. And in a lot of circumstances, the various states abide by whatever the federal rules are. How does this section of the code relate to state taxes?
It doesn't. All we're doing with state and income taxes for a business or someone who is a W-2 employee, again, is we're lowering the amount of taxable income that they have to deal with. Okay, like in a business with a leaseback and maybe doing a limited partnership, with an LLC, we can get that down significantly. So all we're doing is just saying, okay, instead of paying calculating their taxes on $1 million, it's going to be calculated on $100,000, for example. Okay, that is what lowers your taxes by adding additional expenses to your business. On a W-2 side, you're pretty much limited. All you can do is just do the charitable deduction, donation, and doing it that way. But again, that's going to help them because that's a big chunk of their money. They're planning on doing about $600,000. So that's going to move $600,000 that would have been taxable income for them out of the taxable income realm. And that means they're going to pay lower taxes.
Right. And does the pay taxes in New York? It's not the charitable trust, but if you have any active income, there's no state jurisdiction at all.
Income, but this trust never has active income. Right.
Okay. Interesting.
Yes.
Cool. Well, this has been really interesting, Don. There's a lot to digest. I hope our listeners are able to keep up with all the cool technicalities you're sharing with us. How can people get a hold of you if they want to explore this further?
Let me just give one caveat, just to break it down in simple terms, okay?
Please.
There are 4 main benefits. All you got to understand is the benefits, okay? So initially, again, if you have any kind of passive investment income, if you have real estate where you have rents coming in, if you have some kind of a asset that someone leases, the lease payments, okay? If you have investments that or like limited partnerships, things like that, that type of income, if you have that, you can have the trust be the owner of those assets that generate that kind of income, and that will not be a taxable event for the trust. If you have assets that would generate or trigger a capital gains tax event when you sell them, again, get them in the trust first, sell them, will not be a capital gains event. If you have a business or you're a 1099 person and you want to lower your taxes tremendously, or how much taxable income is available in your business entity, then you can work with the trust to do that with a leaseback strategy, things like that. And finally, it has a spend-thrift provision, so those assets are locked down tight. The only way anybody can penetrate that trust is if they do criminal activity or they did fraudulent conveyance. They improperly sold their assets to the trust. Like, for example, if you had a lawsuit that was filed and you quickly put everything in there, that's fraudulent conveyance. They're going to crack it.
Sure.
Right?
Sure.
So that is the main. If you just understand what benefits you get, that covers it, and that's a lot that you can do. So,
right on. Okay, well, that's very helpful. Boiling it down into those 4 points. What where can people learn more? Do you have content you want to plug or website or anything?
Yes, I have a website. It's called www.thespendthrifttrust.com.
thespendthrifttrust.com. This whole conversation is just a really good example of the creative ways that you can arrange assets and really organize your own and your estate's tax situation through just thoughtful estate planning. You think ahead, try to get an idea of what you're really trying to accomplish in your life and with your finances. And there are a million ways to get creative with this kind of stuff, as Don has clearly enlightened us on today. So I really appreciate you being on, Don. What should we leave people with here?
One more thing.
Go ahead.
Just to remind people, I'm an educator. I'm not a licensed professional. I'm not giving, this is informational purposes only. Okay. So we always recommend that you get, advice from a licensed professional, attorneys, CPAs, don't recommend you take my word alone. Oftentimes, we have our attorneys that talk to people to make sure you get legal, professional advice before you enter into any financial transaction.
That is a good reminder. We've got a disclaimer at the beginning of each episode too, with similar language. So thanks for adding that. Thanks, Don. Appreciate it.
Thank you very much.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.